Robschild, nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said, millionaires don't need astrologers, but billionaires do. And so we begin. Today is Monday, June 3rd, 2024. Importantly, the ISM manufacturing came in weaker than expected at 48.7%. Expected was 49.6, and the last was 49.2. So we expected it to slow down less, and instead it's slowing down more. I will be talking about this until it happens. It's no longer next week. Gotta erase that part. Sorry. Friday, unemployment coming out. Very important data. I'm gonna go over that chart again. This is the most important chart to be following, and that data comes out on this Friday. And so, as I've been talking about for a while now, I think I should scroll out a little bit further on this, maybe. We had unemployment from, this, as it is right now, the chart you see, August 2021, 5.51. We've been going down and down and down and down, and we finally seem to have hit a bottom at 3.4% unemployment rate in January, going up, then back down to 3.4. And ever since April of 2023, almost more than a year ago now, we've gone higher highs, higher lows, higher highs, higher lows, higher high, higher low. And now the market's predicting that the May reading of this will be flat at 3.9. Is it going to surprise us to the upside? This is the real big number to pay attention to. If you scroll out on this chart, you can see how important it is. Each gray bar represents a recession, and as you can see, one of the big problems with the recessions is everybody loses their jobs, and what tends to happen is this tends to trickle down, and then eventually you get a bottom, and then once you start ticking up and up and up and up, it's like that means you're in a recession every time, And so, are we at that point right now where it's about to really skyrocket up or not? Is this one of these periods where it's going to flatten out and go down a little bit? It doesn't seem like it typically happens that way. If you even just take a look at this chart, once you start curling up, higher highs, higher lows, to my eye, when I look at this chart, it seems inevitable that it's going to be skyrocketing from this point, but we'll see. On to the manufacturing PMI data. This comes from prnewswire.com. Great chart here showing the details, breaking down manufacturing PMI number. What I love about this is it shows the rate of change. So you don't even have to look at the chart and see how it's going. And and so it's contracting at a faster rate, the PMI, and then it breaks it down. New orders very, very weak at 45, and then backlog orders looking pretty weak as well, contracting at a faster rate. And so, there is pretty good evidence of slowing happening here. Now, according to the way this interprets data, the overall economy is growing at a slower pace, and the manufacturing sector is contracting at a faster pace. So there you go. S&P 500, I've been talking about how it's been getting kind of boring here. I think I'm not the only one waiting for this unemployment data to come out. And so, we're going sideways. The market wants to go sideways, doesn't know what to do here. Fear and greed indexed 51. I said that, this whole week I suspect we are going to be bouncing, that 50 will act as sort of a magnet, and it seems to be operating that way so far, sort of wobbling back and forth in this neutral area. I mean, at this point, a good question is, what is the Goldilocks scenario here? We want unemployment to go up so the Fed can comfortably lower rates, and that makes everything better, right? It's like, if you look at every cycle, once they start cutting, they're usually too late, and people have already decided, like, no, we're doing less business. People have already decided, no, we're spending less money. That's when you get that contraction. That's when you get that very normal business cycle, recession, maybe even a depression, but we'll see. This is from investing.com. I just wanted to point out the Fed funds futures finally took the hike off of the table last week. I thought I saw a few weeks ago, well, you can even see it on this chart. I can't point the mouse at it, but if you look towards the right, you see a spike in the probability of the max target rate, 5.75. That represents 125 basis point hike. I remember that day when it went up to like 6% or something, and then we had another little spike recently, and now we're back to it being taken off the table completely. I think the data coming out is not strong enough to start getting people to fear another hike. So there's they've been, and this is the thing, they've been saying we're not going to hike, we're not going to hike, we're not going to hike. But then the market started sniffing out, hey, you guys might have to hike if inflation is worse than you think. And since then, that fear has gone away. That's where we are now. Adding to the less fear, I guess you can call it, of inflation, we had a pretty big drop in the Treasury yields today, especially 10-year and 30-year yield. Gareth Soloway on his show noted a chart pattern here talking about how if you take this line like this, you hit it 1, 2, 3, 4, 5. This is the 6th time. 7th time is oftentimes the magic number where you break through. And, if you have the line going over here, you only hit it 1, 2, 3 times. And so this is a much stronger line. He's saying, he said on his show, that this adds to the idea that it can break lower. I'm highly, highly exposed to interest rates myself right now. I have 50% of my portfolio in various, the shortest duration is like 24 years, and then I have leveraged products on top of that. So I'm expecting to yields to be really sinking over the next few months personally. Again, never advice. Don't take my advice. If you're better off putting it in a wheelbarrow and lighting it on fire and dumping it off a bridge. Very similar looking chart going on in the 30-year Treasury yield. 1, 2, 3, 4, if you count that. I don't know. We keep hitting this line. Are we going to finally break through it here? And if we do, chart pattern wise, it being potentially a bear flag, the target I've been talking about myself for a while now on the 10-year and the 30-year, around 3.5%. Gareth, by the way, on his show is aiming for 4%. So I'm a little bit more of a hog than he is in this regard, and I think I will. If this does play out, I imagine I will hold it. I might take some off the table, some of the leverage off the table at 4 actually, and then the rest of it at 3, or more of it at 3.5, depending on what's going on. I'll keep everybody updated. Notably, crude oil dropped pretty dramatically today. Again, the price of crude oil oftentimes lines up pretty well with Treasury yields. It's simply it's pretty easy math, really. If the economy is slowing down, people are going to be using less resources, especially less oil, and so the price can go down, and then yields kind of are forced to go down in order to attract more investment, basically. Here's TLT. This is the most common ETF used for Treasury bonds. This is like where I'm most exposed. As you can see, we've if you look at it from this perspective of the price of the ETF, we broke strongly and clearly through a trend line here today, actually. And so my question is like, can we have a close? Can we have a close above today's close in TLT? For me, that would give a lot of strength to this market, just because of how many players out there basically use TLT and they're all seeing the same thing I am. I'm not the only person looking at this chart and saying like, "Wow, we just like snapped through there," and you know, this can help give it a lot of support to go to the upside, and then you know, if that happens, we'll see obviously a correlation with the yields um, truly breaking through that trend line we just looked at. Last chart, there's a lot of lines on here. I was trying to figure out all these different trend lines on Brazilian ETF, and again, I'm excited about Brazil. This chart goes all the way back to 2008, you know, with a trend, with essentially a wedge pattern, which we hit 1, 2, 3, 4, well, 1, 2, 3, 4, 5, sort of broke through it on the 6th knock, and then today we've actually, this same trend line, we're like touching it right now. If you zoom in on it, we touched it exactly today from the way I had it before, and there's other correlating trend lines that can give this a lot of support here. So if there was ever a time to get into Brazilian equities, I would think now is a very opportune time to do so. Overall, things are treading water. So there's some suspicion out there that unemployment might be worse than a lot of people think. I can tell you from seeing in from personal experience, of course, this is not like survey data, but a lot of people are leaving Florida. A lot of people are, which by the way tends to happen when things are going south. Teacher layoffs. Lots of teacher layoffs down here in Florida, as well as other states. There's more and more evidence that I'm seeing personally that there's slowing down going on here. But again, we're treading water here. We're waiting for the unemployment numbers to come out Friday and see if things get exciting then. And that's all I have for you today. Hope you enjoyed. Thank you for watching. Robschild.